I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show. And today we are answering a question a lot of people ask, which is, hey, Mortgage Brothers, how much can we qualify for? Or how much should we qualify for?
Yeah, the key word is should. You have people walking around, going to school, getting their degrees and getting new jobs. And all of a sudden it's like, boom, and V8 hits them. They're like, what price home should I be looking at? What the heck?
That's right. It doesn't matter.
Yeah.
No matter where you are in the market, no matter when you're watching this, doesn't matter what prices are. I know that there's so many variables that go into this, but really the question is how much should you, I think, if you're to be responsible, like on your monthly budget, how much should you keep your mortgage payment below? And what does that translate to on a home price?
Yeah, so if you're fiscally responsible, you have all your little budget line items, how much you spend on your cell phone, how much you spend on your car, how much you spend on this, eating out. You're going to have a little line item on there that says, what should I be spending on my home?
Yeah, so we're going to try to put up on the screen some examples. And I think that there's the first scenario question. The first scenarios are, what could you? That means, what would the bank allow you to get approved for? And if you look, we'll put this on the screen here. We'll make some assumptions. If your annual income is $50,000, and we'll list $50,000, $75,000, $100,000, and $150,000. These are your incomes. And then we're just going to throw in some debt. If your monthly debt's between $500 and $1,000, for those, in those scenarios. Generally speaking, we're going to give you these numbers. Now I will say this is based off of an interest rate. Our calculations roughly around 4%. That is not where interest rates are today. And it may be below or above when you're watching this show as far as that rate. So I'm just giving you some disclaimer on that.
We were just trying to be very conservative. So I think that's important for borrowers to know. And again, this is the could afford, not the should.
Right. So let's just take one of these numbers on here. Let's take someone who makes $100,000 in household income. They if they have monthly debt at $750 a month, like just monthly debt, and that's credit report debt, monthly debt, not your cell phone, not your monthly utilities. It's just what shows up on your credit report, what your minimum payments are. Okay, so if you have the $750 monthly debt, you could get approved up to a loan amount approximately of $475,000. And that would translate to roughly a 30-year fixed payment of $3,000 a month.
Mm-hmm. And on a percentage basis, just to give people some framework here, that would represent about 35% of your income, correct?
All right. So now I think it's pretty easy just to look at that, look at these numbers and say, okay, these are what the bank would give you. Okay. Well, what should you? What would be the responsible thing to do? I think in a monthly budget, Tom and I have really talked about this, and we really came up with this idea that monthly housing debt should not exceed 25% of your monthly gross income. Mm-hmm.
Right, gross income. This is not after taxes. This is before taxes, and there's going to be caveats, and there's going to be exceptions to every single rule. Whether you're first time home buyer or whether you're the last time home buyer, there's going to be exceptions to this. So this is just a general rule as you're talking to yourself or to your significant other on what we should be buying next.
Yeah. So, what we're going to do is we're going to provide another graph here these numbers showing annual income. If take that same person who is making $100,000 of annual income, if they have that same debt of $750 a month, they should, to keep their monthly payments at about 25% of their gross income, they should not be getting a loan above $342,000. That would keep their monthly payments total around $2,080 around that. That's a general rule. I think that's a good place to be. And like you said, Tom, I mean, it depends on if you're a first-time home buyer or you have a young family, you're growing, you need that extra house, of course, these numbers you can stretch up. But I think to keep a good, healthy budget, try to keep it at these numbers, at these ratios.
Yeah, and I remember, before I got in the mortgage business, I was always a little bit curious. I've been a little conservative by nature, but I would have loved to have heard these numbers. As I was renting a place, trying to think about getting my home, or frankly, upgrading my family, upgrading to that bigger home. What should I be doing?
And we are recording this at a time here in February of 2021. Or sorry, March 2021, and the market is crazy hot. I mean, it is hard to find houses. It's very competitive. So no matter when you're watching this, it may be as competitive, like it may be as hot or not. But the point is that you're going to be looking at homes. And you may have to stretch, right? You may have to really, really stretch. So I know it's hard.
If you've got to stretch, maybe you just, a couple less Starbucks drive-throughs, and we can go into what a Starbucks means on a monthly mortgage payment budget. That's an interesting conversation and podcast. But can I just throw this thought out there? For those that are later in life, those that are a little more seasoned, have bigger 401ks, have bigger retirement, have more money, you could also use this as a general rule for all your real estate, for your second home, for your cabin. Should I be thinking about buying a cabin up north? It's going to be getting hot soon. I think as a general rule, if your real estate, of all your real estate payments, and again, not including investment properties, were within that 25%-ish budget range, I think that would also be applicable. So something I'll throw out there,
That's right. So each person's right. It has a unique situation. Your loan officer is going to be able to help you really gauge what the bank will let you get, what you could get approved for. And then a good loan officer should also give you good counsel on what you should, right? If I look at a situation, depending on age, what they're telling me, I can give them a good recommendation. Tom, we do that every day. So anyone has questions on that or needs our advice, please let us know.
Okay, so just to recap, the range is between 25 and 35%. Okay, the what home should I buy? It's probably around 25%. What home could I buy? Probably around that 35%, and that's of your gross income.
Your monthly payment, right? That's your monthly payment should not exceed 25% of your gross income on what you should get qualified for.
Mm-hmm. Exactly.
And 35% is probably what the bank will tell you you're approved up to.
Yeah.
Okay.
Awesome.
If you like this show, like what we're doing here, please like and subscribe to this channel and you will be notified. Click that bell. And again, let us know, email us if you have any questions. And I hope this helps.
Awesome. Thanks a lot, folks.
Thank you, everyone. Hey guys, thanks for listening to the Mortgage Brothers podcast. Please let us know if you have any questions you'd like us to answer. You can email your questions to team@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. We'll be sure to give you personalized service and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.